Current market action for Salesforce Inc., ticker symbol CRM, shows the stock trading live at 243.90 USD, representing a strong intraday push of positive 5.24 or roughly 2.19% in the green. When you look at that price action on the screen, the immediate expectation from the broader retail crowd is often that a legacy software giant like Salesforce is simply riding a general tech wave or perhaps bouncing off a technical support level. The consensus view, the expectation, is that Salesforce is a boring back-end utility for businesses, a company whose best growth days are comfortably in the rearview mirror, destined to grow slowly while newer, shinier AI startups steal the headlines. Investors see a 25-year-old cloud company and assume the narrative is purely about margin preservation and share buybacks. But the reality, which is actively unfolding in the trading sessions right now, contradicts that sleepy assessment entirely. What we are witnessing is not a passive drift upward, but a fundamental repricing based on a massive structural pivot that Wall Street is only just beginning to properly digest. The reality is that Salesforce is not merely adopting artificial intelligence, they are effectively weaponizing their massive data dominance to transition from a software-as-a-service model to an agent-as-a-service model. And the Q3 earnings data released just yesterday confirms that this bet is paying off faster than even the bulls anticipated. The gap between that boring utility expectation and this autonomous agent reality is where the alpha sits today, and that is why we are seeing this persistent bid under the stock price this morning. To understand why this specific price point of 243.90 matters, we have to look closely at the catalyst that just hit the wires. Salesforce reported their third quarter fiscal year 2026 results yesterday, December 3rd, and the numbers effectively silenced the bears who had been arguing that the company was losing market share to Microsoft or smaller, nimble AI players. The company delivered revenue of $10.3 billion, up 9% year over year. While 9% growth might not sound explosive compared to a volatile small cap, for a company of this sheer size, it is a significant signal of durability. But the headline number is not what is driving the stock today. The real story, the one that institutional desks are scrambling to model, is the rapid adoption of Agentforce. This is their new suite of autonomous AI agents. The expectation was that Agentforce would be a slow burn, a show-me story for 2026 or 2027. The reality delivered in the print was a shock. Agentforce and Data 360 combined annual recurring revenue is already nearing $1.4 billion, growing at a massive 114% year over year. They signed 9,500 paid Agentforce deals. This is not vaporware. This is commercial traction happening right now, faster than anyone projected. The market is realizing that Salesforce has a moat that is incredibly difficult to cross: customer data. While everyone is talking about Nvidia stock and the hardware required to run these models, or Apple stock and the consumer interface, Salesforce sits on the actual customer records, the sales history, the service tickets, the marketing interactions that businesses need to make AI useful. You can't have a useful AI agent if it doesn't have access to the context of your customer relationship. This is where the concept of Data 360 comes into play. It's the plumbing that connects all that disjointed data so the AI can actually do work. The market had assumed Salesforce was late to the AI party. The earnings report proved they were simply building a different kind of venue. The stock is reacting to this realization. If Salesforce can successfully transition its massive installed base to these higher-value autonomous agent contracts, the lifetime value of every customer goes up, and the stickiness of the platform increases dramatically. Let's talk about the specific intraday dynamics we're seeing. The volume today is robust, suggesting this is not just retail traders chasing a headline, but institutional accumulation. When you see a move of over 2% on a company with a market cap over $200 billion, that requires heavy buying power. It indicates that portfolio managers are re-rating the stock. They are looking at the raised guidance. Salesforce bumped their full-year revenue outlook to between $41.45 and $41.55 billion and deciding that the risk-reward ratio has shifted. It's worth noting that this move comes in a mixed macroeconomic environment. We're seeing some rotation out of highly speculative assets and back into profitable growth, a category Salesforce now squarely occupies. The company is no longer just burning cash to acquire customers, they are printing free cash flow. Operating cash flow for the quarter was $2.3 billion, up 17%. That creates a floor under the stock price because it gives them ample firepower for share buy purchases and potential dividends, offering a safety net that purely speculative AI plays simply do not have. It's interesting to contrast this with how an individual investor might look at Schwab Intelligent Portfolios or Fidelity accounts. Often, retail investors using online investment tools or investing sites see a stock down 30% year-to-date, as Salesforce has been for much of 2025, and assume something is broken. They might see the chart and think it's a falling knife. But a professional analyst looks at that same chart and sees a coiled spring. The sentiment had become too negative. The fear was that AI would replace the need for sales seats, thus hurting Salesforce's core per-seat pricing model. That was the bear case. AI reduces headcount, Salesforce sells fewer licenses. The counter-narrative emerging now is that while headcount might slow, the consumption of agent credits will skyrocket. If a digital agent can do the work of a human SDR for a fraction of the cost, but still requires a Salesforce subscription to operate, the revenue quality actually improves. It becomes higher-margin software revenue rather than seat-based revenue. This mental shift from AI kills SaaS seats to AI enables higher-margin usage is the core driver of the bullish thesis we are seeing play out in the price action today. While we are discussing market mechanics, let's take a quick pulse on the broader sector context. Interactive brokers data and Robinhood activity often show us where the retail sentiment is flowing, and right now there's a clear broadening of the AI trade. For a long time, it was just chips and infrastructure. Now we're seeing the application layer wake up. Investors are asking, okay, we bought the chips, now who's actually making money using them? Salesforce is raising its hand. This is similar to the rotation we've seen with SoFi or SoFi Invest users moving from purely speculative crypto plays into more grounded tech heavyweights. When you use a Fidelity mobile app or a Fidelity trading platform to check sector performance, you'll likely see software lagging hardware for the last 18 months. That gap is starting to close. Salesforce leading the charge today is a signal that the software depression might be ending. If you're managing your own individual brokerage account, this is a trend to watch closely. The rotation from the pick-and-shovel hardware makers to the gold miner software companies who are finally extracting value from these tools. Now, let's step back and look at the company itself for those who might only know the ticker symbol. Salesforce is the world's dominant customer relationship management platform. In simple terms, they build the digital dashboard that companies use to track every interaction with a customer. If you call a customer service line, the agent is likely looking at a Salesforce screen. If a salesperson emails you, it's tracked in Salesforce. They expanded this dominance through massive acquisitions over the last decade, buying Tableau for data visualization, MuleSoft for data integration, and most notably, Slack for workplace communication. The business model has historically been SaaS, software as a service, where companies pay a monthly fee per user. It's incredibly predictable and incredibly sticky. Once a company moves its entire database to Salesforce, leaving is a nightmare. This high switching cost is the company's greatest defensive asset. However, the criticism for years was that they bought too many companies and lost focus, bloating their expenses. That's why the recent focus on margins and the profitable growth framework has been so critical. They stopped buying massive companies and started focusing on integrating what they already own. The result is the Agentforce platform, which unifies all these pieces, Slack as the interface, Tableau as the analytics, MuleSoft as the connector, into a single engine for AI agents. This brings us to a crucial point about the future outlook. The expectation is that AI will be a commodity, that Google or OpenAI will just offer cheap agents that make Salesforce irrelevant. The reality, and the contrarian take that supports a bullish view, is that AI models are a commodity, but context is scarce. An AI model from OpenAI doesn't know your customer purchase history unless you give it that data. Salesforce owns the data. Therefore, Salesforce agents will always be smarter about your business than a generic model. This context advantage is what the market is betting on. If Salesforce can prove that their agents resolve customer service tickets 50% faster because they have access to the full history, companies will pay a premium for that regardless of how cheap generic AI becomes. There are risks, of course. We must address them to maintain a